Okay, so you're ready to dive into dividend stocks, especially with the economy being, well, a little unpredictable lately. Smart move. Everyone loves a little passive income, right? And when the market's being a bit dramatic, those dividend payouts can really help stabilize things.
Absolutely. Adds a bit of predictability in uncertain times.
Exactly. And we've got an article here that highlights two companies that are worth a closer look this month. One that's relatively new to this whole dividend scene, and another that's been how do you say it, a dividend aristocrat for decades.
Yeah, a classic dividend play versus a potential rising star. It'll be interesting to see how they stack up.
Right. So first up, we've got Ally. They're an all-digital bank, which always makes me think new kid on the block.
Right, but they've actually been around for over a century.
Really? I did not know that.
Yeah, they started as the financial arm of General Motors.
Wild, huh? Wow. That's a blast from the past. So how'd they make the leap to digital banking?
They spun off from GM back in 2009 and went fully digital. Talk about perfect timing. That move positioned them perfectly to ride the wave of the digital banking boom.
And boom, they did. The article mentions they're now the largest all-digital bank in the U.S.
Yeah, a major player in auto loans, too, and hold their own as the 23rd largest bank in the country by assets.
Not bad. Not bad at all. But speaking of those auto loans, I know their CFO made some headlines last month, something about higher than expected loan defaults.
Yeah, that definitely made some investors nervous, which is why we're seeing their stock price dip a bit.
So potentially a buying opportunity or a sign of trouble brewing. That's what makes these deep dives so interesting, right? Trying to read those tea leaves.
For sure, it's all about weighing the risks and potential rewards.
All right. So should we be worried about these defaults?
Well, a default is basically when borrowers can't repay their loans. For Ally, a higher percentage of those auto loans going into default could mean lower profits. That's the simplest way to put it.
Makes sense. But then there's that whole interest rate thing, right? The Fed just lowered rates again, didn't they?
They did, and that could actually play in Ally's favor.
Okay, now remind me how that works again. Lower interest rates. How does that impact a bank like Ally?
Sure. So when interest rates are high, banks make more money from the loans they give out.
Right, because they're charging higher interest.
Exactly. But they also have to pay more to depositors to keep their money with them.
Mm.
And at the same time, borrowers might struggle to keep up with those higher loan payments, which can lead to, you guessed it, more defaults.
Ah, I see.
So lower interest rates, in theory, could mean a more stable borrowing environment, fewer defaults, and potentially a boost to Ally's bottom line.
Interesting. So we've got a lower stock price, potentially fewer defaults down the line. And on top of all that, they're offering a 3.4% dividend yield. That's significantly higher than what I'm seeing from a lot of the bigger banks right now.
It is. But a high dividend yield doesn't tell the whole story. We need to look at their payout ratio, how much of their profit they're actually paying out as dividends, to see if it's sustainable.
Good point. Got to look under the hood, so to speak. Okay, so Ally, the digital disruptor, has some potential, but comes with its own set of questions, like can they keep those auto loans from going belly up? Now, let's switch gears to something a bit more, how should I put it, predictable.
The Rock of Gibraltar, perhaps.
Exactly. Prudential. They've been around for almost 150 years, and that logo, that iconic Rock of Gibraltar, just screams stability. But they're not just about insurance anymore, are they? They've definitely branched out. I've heard they're making big moves in wealth management, retirement strategies, even something called private alternative capital deployment.
That's right. Diversifying their portfolio, which is key for any company, especially these days. To your point about private alternative capital deployment, it essentially means they're investing in assets beyond traditional stocks and bonds. Think real estate, private equity, infrastructure projects. This can be a good sign for dividend investors because it often generates strong, consistent returns, potentially boosting those dividend payouts even further.
So adding a bit of spice to the mix. But at their core, Prudential still seems to be all about stability.
Absolutely. They have a global reach with 50 million customers in 50 countries and manage about $1.5 trillion in assets. That kind of scale provides a level of security and resilience that's hard to match. Plus, they've been consistently paying dividends for over 2 decades.
Speaking of, their current dividend yield is 4.3%, which I have to point out is more than 3 times the average for the S&P 500. Why is their yield so much higher?
It's a combination of factors. First, their size and established market presence allow them to generate significant cash flow. They're also known for their robust credit management practices.
Okay, hold on. What does robust credit management actually mean?
It means they have strict lending standards and risk assessment processes, which helps them minimize defaults on loans and investments. Remember we talked about Ally's potential issue with auto loan defaults. Prudential's stringent credit management helps them sidestep similar pitfalls.
Makes sense. So they're careful with their money, which in turn makes them a potentially safer bet for dividend investors.
Exactly. And unlike Ally, which is more sensitive to interest rate fluctuations because of their focus on lending, Prudential's diverse range of services provides a buffer against those ups and downs.
So even if interest rates rise, Prudential is less likely to be significantly impacted.
Precisely. While rising interest rates can impact different parts of their business in various ways, their overall diversification makes them less susceptible to dramatic swings compared to a bank like Ally. Now, that's not to say there are no risks. Investing always involves a degree of risk.
Right. No such thing as a free lunch. But Prudential's long track record of dividend payments and their consistent dividend growth, it's up 30% over the past 5 years, does paint a picture of reliability.
It does, but like any investment decision, it's crucial to look at the whole picture. Don't just chase a high yield. You want to consider their payout ratio, which indicates how much of their earnings are going towards those dividends. A healthy payout ratio suggests they can comfortably maintain and even grow those dividends over time.
So we've got Ally, the relative newcomer, with a potentially attractive yield but facing some uncertainty. And then there's Prudential, the established player known for stability and consistent payouts. Two very different companies, both offering potentially lucrative opportunities for dividend investors. But before we get ahead of ourselves, let's step back for a moment. What are some key takeaways you want our listener to keep in mind as they evaluate these options or other dividend stocks? It's easy to get caught up in chasing those high yields, but like you said, got to look at the whole picture. What other factors should our listeners be thinking about when they're evaluating these companies, or really any dividend stock for that matter?
Well, we touched on interest rates, but inflation is another big one these days.
Right, prices going up on everything.
Exactly. And even if a company's paying a decent dividend, high inflation can eat away at the purchasing power of those payouts over time. So you want to make sure those dividends are growing at a rate that outpaces inflation. Otherwise, you're essentially losing ground.
Yeah, that dividend check might look good on paper, but if it's not keeping up with the cost of, well, everything, it's not doing you much good.
Exactly. And then on top of all that, you've got those geopolitical risks, things that are totally out of any one company's control.
Like, give me some examples.
Trade tensions, political instability, you name it. Those things can create a lot of uncertainty in the market and potentially impact a company's bottom line, even if they're not directly involved.
It's a lot to keep track of. So how can our listeners stay ahead of the curve, make those informed decisions? It feels like every day there's a new headline to digest.
Staying informed is key. Make it a habit to read financial news, understand those factors influencing the market, and don't be afraid to adjust your investment strategy as needed. And this is a big one. Diversify that portfolio, not just across different companies or sectors, but geographically too.
Don't put all your eggs in one basket. Or one region, I guess.
Precisely. Think of it as creating a safety net for your investments.
Love that analogy. So, big picture, Ally and Prudential. Two very different companies, two different approaches to dividends. It's fascinating to see how they each operate within this larger economic landscape.
It really highlights how crucial it is to go beyond those surface-level metrics, like a high dividend yield, and really dig deep. Understand a company's financials, their strengths, potential weaknesses, you name it. Do your research.
Couldn't agree more. This deep dive has definitely given me, and hopefully our listeners, a lot to think about. Any final words of wisdom as we wrap things up?
Just remember, knowledge is power. The more you understand about investing, the more confident you'll be in navigating those financial waters. Keep asking questions, keep learning, and hey, don't be afraid to seek guidance from a financial advisor if you need it. There's no shame in asking for help.
Well said, because at the end of the day, it's all about achieving those financial dreams, whatever they may be. Thanks for joining us on The Deep Dive. Until next time, keep those dividends flowing and those investment goals in sight.